BIM, folks, how are we? Second video, big things continue to happen. In this video, I'm going to talk about income protection. If you are thinking about getting income protection, you should definitely watch this video. If you've already got income protection, you should also watch this video, just to help you critique the cover that you've already got. I'm going to be talking about whether people need income protection and a couple of the alternatives to income protection, a couple of misconceptions about income protection, and the key parameters that go into the policy, as well as price. What should you pay for income protection? So I will knock those points off. Look, with income protection, it's not a policy that everyone has. I have friends that are quite smart people that don't have income protection policies. But there's definitely things in this video I think they don't know. I've got one mate in particular, and this is not an uncommon position on income protection, that it's kind of like the casino, and the casino always wins. In this case, the insurer is the casino, and they stack the odds against you in terms of claiming. But I'm going to give you some very compelling evidence towards the end of the video as to why I don't believe this is true. Well, at least what I believe is compelling evidence. First thing I want to talk about is the alternatives. So, do you need income protection? Let's have a look at the alternative. First alternative being Social Security. So with Social Security, or the DOL, JobKeeper as they call it, first thing you need to know is that it's $750 a fortnight. That's the most you can get as a single person, about $750 a fortnight. So right then you can go and say, hey, this is my budget, this will be enough, or this won't be enough. Okay, $750 a fortnight works out to about $20K for the year. Okay, so the other thing you got to know about the DOL is that it is asset tested. If you have assets, they will impinge on your ability to get the full amount of that $750. So that's another thing to be aware of. If you've got a house that you live in, generally your property isn't a part of the asset test, but $400,000 at a 5% interest rate, that's already $20,000 in and of itself. So if you were getting the full job seeker payment, it would be covered. It would just cover the interest, and that's not including principal. That's not including bills, food on the table, etc. So that's what you want to think about when you think about the DOL. Now, most people who watch this probably already know that the DOL is not going to be suitable for them. The next thing that they're going to consider is workers' compensation. Okay, a couple of things about workers' compensation you need to be aware of. First key thing is that it will only pay out if your injury or illness is due to your work or incurred at work. Okay, so if you are off on the weekend, doing whatever you do for fun and get hurt, that's something you're not going to be able to claim on the policy for. And I had a quick Google trying to find some data on where people, statistically are likely to get injured. Couldn't find a lot of data, to be honest, but I did find some data from the National Safety Council in the United States. So if we assume that that's kind of similar to other Western countries, they basically, I'll put this on the screen, they basically found that 76% of injuries that require medical attention are incurred at home. So you can see the pie chart up there. So that gives you an idea. If you are relying on workers' compensation, you have to consider, hey, am I willing to take that risk when I know that this amount of injuries are likely to happen at home and I may not be able to claim on them? Okay, so if you're thinking workers' compensation is not suitable, then continue watching, because we can talk a little bit about income protection now. First thing I want to talk about in terms of misconceptions about income protection is that income protection, so I used to sell income protection. I worked for TAL, the largest life insurer in Australia, for quite a few years, and I heard this a lot of the time. I work in an office, I can work from home, I don't need income protection. Right? It's not quite that binary, in my opinion. There's more nuance to answering the question of whether you need it or not. Okay, the insurer will price the risk around you as a client based on where you work, what your job is, your qualifications, your income, your gender, your age, your medical history, what pastimes you have. All these will feed into what you're offered by the insurer. So if you are working in an office, you're a white collar worker, you're not going to get charged the same amount as someone who's out digging ditches on a construction site. Okay, but if to say that you you're an office worker or you can work from home, and you don't need income protection, that's basically suggesting that your work environment negates all risk of an injury. Okay, so I think there's more nuance to it. You can think about that for yourself. The second misconception that I would hear often was that I have a whole lot of savings, so I have a whole lot of leave, sick leave, I can survive for this long, so I don't need income protection. So that this long could be, let's say, 6 months, right? The question is simply, what happens after 6 months? What are you going to do at that point in time if you have an injury or an illness that's serious enough that you can't work? And I should probably also mention that with income protection, you can claim if you're sick or if you're injured and you can't work. A lot of policies, just so that you're aware of this, a lot of policies will not allow you to claim for becoming redundant. If you get fired, you're not going to find a policy that will cover you at all, but some will cover, redundancy with limitations. But generally, it's sickness or injury. I should probably clear that up at the start. But look, so yes, how long you can survive without an income. So let's say you've got sick leave, you've got savings, you can survive 6 months. What the insurers generally allow you to do is choose a waiting period. So at the time that when you initially take out the policy, you can choose a waiting period. Now, this could be 1 month, 3 months, 6 months. Some insurers offer waiting periods of 2 years. So, and as you might imagine, with longer waiting periods, the policy is cheaper. Okay, shorter waiting periods, policy is more expensive because the likelihood of you receiving a payment from the insurer is higher. Okay, so just to be clear, the waiting period starts from the day that you get sick or injured. Okay, so that's when you're going to have to rely on those savings or that sick leave initially. When that runs out, hopefully you've planned it so that your waiting period ends and you start to receive payments from the insurer. So look, that addresses the savings misconception and also one of the first key parameters, which is the waiting period. Second key parameter is going to be the benefit period for the policy. With the benefit period, this is, as you might imagine, how long you can continue to receive payments if you are sick or injured. You can't receive them forever, okay? That's another misconception that some people have. The insurer's not just going to keep paying you until you get to work. No, until you get back to work. It depends whatever comes first, getting back to work or the end of the benefit period. Now, when you initially apply for the policy, that's when you choose the benefit period, and the longer the benefit period is, the more expensive the policy is going to be. There are benefit periods all the way up to the age of 65. Okay, there's benefit periods of some insurers offer 6 months, 1 year. Okay, obviously the shorter benefit periods are cheaper. What benefit period should you choose? Well, it sort of comes down to risk tolerance, in my opinion. There is no right or wrong answer. It's a trade-off. You get more cover with longer benefit periods at a higher price. So you've got to just see what gives you peace of mind, what helps you sleep at night. Okay, so that's benefit period. The last key parameter is how much cover do you need? So income protection is usually quoted with monthly benefit amounts. So this would be how much they pay you each month when you end up on a claim. The maximum amount of cover you can get currently is 70%. Okay, that's an APRA regulated parameter. You can't get more than 70%, generally speaking. 70%. Now, you don't have to take out 70% of your income. That's just the cap. So if you wanted to take out less cover, you can do so. If you take out 20% less cover, you're going to pay roughly 20% less in premiums. So just make sure you've got enough to suit your lifestyle and your budget. So that's the last key parameter. Okay, so price. So I want to talk about price and dispel that casino myth. The casino always wins myth, right, about insurers. And the way I want to do that is tell you about profitability of income protection. So this to me is very compelling evidence that income protection isn't overpriced, right? Income protection, the 5 years leading up to 2019, the industry, personal risk insurance industry as a whole, lost $3.4 billion on income protection because the policies are not profitable. Meaning, basically, they're paying out too many claims and they're not receiving enough in premiums from their clients, on average, right? So that on average means that income protection is well, it's profitable for the client in a sense rather than for the insurer. I don't think the insurers wanted to be the first to change, like whether that be making the policy more expensive or reducing the benefits available, because they probably were afraid that they were going to lose market share or whatever the case may be. But eventually APRA, who regulates the industry, came in and forced them all to make certain changes in 2021. So if you have a pre-2021 policy, you definitely want to think about changing insurers quite seriously, because there's benefits pre-2021 that are no longer available. I might make another video about exactly what those benefits look like and the differences. But yeah, the last few quarters income protection has been more profitable, but it's hard to say whether that's because of those changes that were made or because of interest rates going up, because insurers hold bonds, they have debt, and generally when interest rates go up, it's positive for profitability of life insurers. So yeah, that's the price story. So you look on an individual basis, if you are looking at getting income protection, go and get quotes from multiple insurers, because some insurers, they're going to have their sweet spots, there's certain demographics that they make their policies more competitive for, and if that's not you, then that insurer is not going to be competitive for you. So you should go and try another insurer, as well as the fact that insurers cycle how competitive on average their business or the policies that they offer are. And in my time, I've seen, in one period of time, one insurer will be the most competitive. Then 6 months later, it may be another one. And then 6 months after that, it's going to be another one. All right, they tend to cycle. But yeah, that's pretty much income protection. Hopefully you got some useful information out of that. Thanks for watching.